Okay, good morning, ladies and gentlemen. My name is Paul Duran, and on behalf of the entire team at ELCO Management, thank you for joining us. Today we have Anton Schutz and Dan Goldfarb of Mendon Capital. Anton and Dan are the portfolio managers for the ELCO Financial Services Separately Managed Account Program, which is predominantly invested in regional banks. I would like to remind everyone that today's call is being recorded, and if any questions should arise, please use the Q&A tab at the bottom of the screen. With that, Anton and Dan, maybe we can open the discussion with a why now for regional banks. You know, it's been an anxious time for investors in the space with some headline bank failures over the last 4 quarters. Maybe just set the table with a macro discussion and why our portfolio is different.
Sure, thank you. I appreciate that. And look, I want to set the backdrop as well. As I've done this my entire career. Dan has done it his entire career. We've worked together investing in this space for, cumulatively over 80 years. So it's been a long time of us working in this space. And we see opportunities like this sort of once a decade. And I think that's about right. Timing wise, first of all, valuations are low, and particularly the smaller cap versus the larger. That's driven by liquidity and certainly driven by fear. The other factor that's out there is the fact that we've seen some banks fail, and again, it's created fear. The companies that have failed have had very unique circumstances to them. The big ones that failed last year had a very bad deposit structure. They had a lot of fast money deposits. They had a concerted run on the bank versus those deposits, and they didn't have liquidity to pay for them. They made strategic mistakes about mismatching their balance sheet. They had a lot of long-dated securities and loans and a lot of, obviously, short-dated deposits that could flee. Venture capital was the primary provider of those deposits. I would also say there were some very large real estate developers that were depositors of Signature Bank. Again, between the venture capital and those large group of borrowers and depositors, they all fled at once and created liquidity problems, so they couldn't dump the assets. A couple things out of all of that. First of all, since Dan and I do this for a living, we look at deposit structures. It matters to us. And there are times you may want to own a company that has that type of structure, but that was not the time in a rising rate environment to own those types of names. New York Community Bank, which is the most recent one that was in the headlines, was actually also a very unique case. Created a lot of fear out there, but they were the dominant lender in multifamily real estate in New York City. They had regulators exercise extreme authority over them. The chief accounting officer gone, chief risk officer gone, not because they did anything wrong, because the interesting thing is when they put all those reserves aside, they weren't allocated to particular loans. And that tells you that they couldn't identify the loans they had losses on. And I think that's really important when you think about it. Obviously, a great opportunity for private equity to come in and make a bunch of money. And I think that they will. And I think the real key, and I think that this is what people are missing out there when they're afraid of commercial real estate. And again, Dan and I are also afraid of commercial real estate, but very specific type of properties. We're afraid of certain regions of the country where people are leaving, businesses are leaving. We're afraid of downtowns with high-rise buildings. In those regions, again, those are going to be tough places, where the rules may be different, work from home may be different. So, those types of banks that lend to those types of things are not in our portfolio. Again, something we've looked at a long time ago. There's certainly a few banks out there that we think we're going to have some trouble just because they have that concentration. However, there are close to 5,000 banks in this country, and the vast majority of them do not have downtown high-rise commercial office. And by the way, the ones that do, the bigger banks, the Key Corps, the PNCs of the world, Wells Fargo, have huge loan loss reserves already dedicated to. They've already taken the bad medicine. So whenever some of this stuff doesn't go well, it's already paid for. They've set aside reserves. It's already been in their earnings. The banking industry has lots of capital. This is nothing like 2007 and 2008 from a capital perspective. And the other thing that's really important here is they also have pretty strong loan loss reserves. Like I said, a lot of those downtown properties are reserved for. There's a new accounting treatment called CECL where they have to forecast their losses over a long period of time. And so the reserves are pretty robust. The capital ratios are pretty robust. Management's basically tightened credit in COVID, and they didn't loosen it up very much. So, a lot of dumb ideas have not been funded. The other thing that is different between 2007 and 8 is the fact that a lot of bad products were out there in 2007 and 8. There were negative AM mortgages, there was pick a pay, all sorts of 125 loan to value type of things where, sure, you're going to lose money. I mean, it's just silly practices, and the competitive environment was there. I think a lot of the silly lending that's gone on, if there's been any silly lending, has also gone on in private credit. 80% of the market is now funded outside the banking system. It's a terrible idea. We may harp on regulators and not like how tough they are, but they're tough. And I think that's kept the banking system sound and in good shape. They obviously made some mistakes from a self-dealing perspective in Silicon Valley, where they actually let the CEO be on the board of the San Francisco Fed. I mean, just nonsense. But at the end of the day, the regulators are pretty tough on the banks. The banks are pretty tough on credit. And I think the other thing that's going to happen right now, beyond the valuations being really cheap, is capital builds very quickly at the entire banking industry, because there's not a lot of loan growth. The economy's pretty slow. Every bank will tell us that. The only banks that are growing are doing it because they're hiring people, not because they're necessarily growing more in their own footprint out of their existing staff. Growth is pretty slow. The economy's quiet. It's not collapsing. A lot of people are talking about soft landings or no landing. That might be right. But things are, from an economic activity perspective on the commercial side, relatively quiet. So if you have capital building and you have big discounts to book value or to intrinsic value, you have buybacks coming. You will have M&A coming, again, in an environment where capital builds. You'll have a lot more M&A coming. There's a technology deficit out there in the industry. So banks need to invest, continue to get more efficient. AI will be helpful to them for sure. But a lot of banks will merge simply so they could actually increase their technology budget so they can get more efficient, so they can be faster to market, have better credit, have better regulatory compliance, and actually lower cost. And that's all coming. AI is going to be big everywhere, but particularly in the banking industry, where so much is operations intensive. Those back offices will be smaller, bank profitability will be better. And there is a latent desire to merge in this industry. There is fatigue of managements. There's board fatigue. Managements have literally not been able to engage in heavy M&A activity since 2018. We've seen big choppy moves. 2018 had a very, very large drawdown in bank stock valuation. 2020 had COVID fears. And then certainly we had the failures of last spring. So every time you hit these drops on a chart, and they're pretty dramatic drops, and by the way, we're here right now, the chart looks really good for the banking industry. And given what we're doing, which is looking at community banks, they don't have high rises. The average buildings may be a couple of stories in height, that probably full of medical people that can't work from home. And they've been lent to relatively conservatively, 50, 60% loan to value. So those buildings are full. Loan to values are good. And, there's really no issues brewing within that space. Dan and I meet with literally hundreds of management teams a year. And I'm sure we've already had year to date somewhere in the neighborhood of well over 100 meetings. So it's really important to us. It doesn't mean you trust everybody you meet with, but you do get a collective feel from the room. And I'll tell you, managements are angry. They're angry at their stock prices, which means they're willing to do things. And I will tell you, the board is fatigued. The average age of a board of directors is up over 5 years. So, how do they get compensated? They get compensated with stock, and they would like their stock higher. In fact, some cases might like to check out because the average age is gone up. So I think we're very excited about where valuations are. We are not afraid of commercial real estate for the types of companies we invest in. We do think there will be losses out there. But the other thing that's really, really important for people to recognize about all of that is not every commercial real estate loan is coming to maturity this minute. The average life of those loans may be 5 to 10 years. A lot of them are held by insurance companies. And, until that loan reprices, nothing happens. Now, if buildings are vacant and they don't choose to pay, that's a whole different story. But again, these are downtown high-rise buildings, and honestly, the better quality buildings aren't vacant. It's the lesser quality ones where people are moving to those better quality ones. Our banks typically don't lend to that type of space, not to the size or to the lower quality. Dan, I would love you to catch me up on what I've left behind. I know this has been a long and important conversation, but I know that you've caught a few things I've missed.
Well, Anton, thank you very much. And you really don't miss very much. So I'll try and link your conversation with some of my points. First, you talk about valuation associated with banks today. And primarily, I'm talking smaller versus larger, and you can define smaller any way you want. So I'll say sub 50 billion in terms of total assets, maybe sub 5 or 6 billion on a market cap basis. Presently, using just a PE for 24, the group's anywhere from 7 to 9, 8 to 10 times. So call it an 8 multiple. Many people like to look at a PE relative. And if you use the Russell 2000, which is where most of these stocks would trade, and you remove the non-earners, which is about 33% of the Russell 2000. So now you're getting earning operating companies with earning operating companies. We're trading somewhere between 50 and 55% on a relative basis. That's pretty darn cheap. I've been doing this for 35 years. Thank you, Anton, for talking about earlier our 80 years worth of, working in this industry. That's almost as cheap as it gets when you employ interest rates as the other variable when we think about bank stocks. So I think about bank stocks two ways. One are as operating entities, which we just mentioned, they're pretty darn cheap on a PE basis. And you can look at them also as an acquisition target. So what is the value, the terminal value of an institution? So they're cheap on an operating basis. Are they cheap on a terminal basis? When I look at where they trade on a price to book, they're somewhere between 1 and 1.5 times. Where if we look over the last 25 years, they traded anywhere from about 1 to 2, 2.2 to 3 is the peak. But when we think about what are they worth in a deal, you have to look at a deposit franchise premium. And when I look at that over the last 25 years, the range is essentially 0 through 15%. Right now, for banks under 5 billion in size, they trade at a 6% deposit premium. With those under a billion at 2%. Another way to say it is if we took the average over the last 25 years, they're trading anywhere from a 40 to 80% discount to what the other guy would pay for it. That's about as cheap as it gets. And when I think about times when that occurs, I can think about 89 to 91. I think Texas, 86 when oil was $10 a barrel, 2000, 2002, and obviously the GFC. And given that operating environment today is better than those 4 other periods I just mentioned, these are very, very inexpensive securities.
Thanks, Dan. I think that Tom Lee, who's pretty well published and quoted, talked this morning about the Russell 2000 having 50% upside. Now, what's important is the Russell 2000, about a third of it is financials. So, whether Tom is right or not, we compare quite favorably versus the Russell over history. And if the Russell goes well, usually, certainly our stuff will get dragged along. One of the things that we like to do when we look at a bank is we like to find optionality. And what I mean by that is find a really good operating company in a good geography with a good management team that operates very well, but everybody else wants it. And that is a magical formula, because if that management team raises its hand, then boom, you got a premium. If that management team operates well, you'll get a higher stock price over time. So, we win either way. Many managements over the years, I've got deep relationships, so does Dan, that go back decades. Anton, why are you in our stock? Do you want us to sell? No, I don't want you to sell. I mean, if you can deliver the returns that lead to a higher stock price, I'm perfectly happy for you to operate. And if you can't, then yeah, hit a bid. It's great. You know, we were both at a conference recently where KBW, which is one of the leading firms in the banking space, had about 100 banks, and Dan and I met with probably about a third of them. Another one of our analysts was there as well. The CEO of KBW walked up to me and said, you know, Anton, don't be surprised if you don't walk in some days and see 60 to 80% premiums on some of the small cap stocks. And that resonates obviously very well with what Dan was saying in terms of where the upside is to many of these smaller companies. And we do have positions in the portfolio that trade below tangible book value in very strong geographies, places like Nashville or places like Florida. And there's stuff in Texas that trades also in some of those same multiples. Again, these are states that are growing. There's good economic activity. So really good upside. There's other banks that obviously want to be in those states or would like to consolidate those states and take more market share. So, you know, we think the opportunity is very real. You know, I won't be political, but I'm going to be political because I'm just going to state a simple fact. If perchance the Republican Party wins in November, bank stocks will soar. And I'm going back to 2016. I believe the index was up over 16% in the month of November. You know, if they win, yeah, we'll have a big pop. If they don't win, you're still going to have this group being as cheap as it is and having all the catalysts to lift this group. So it is an interesting observation. You know, you can't bet on it today for sure, but it is a positive catalyst that could potentially develop, certainly for the banking space.
Guys, maybe we can transition here to interest rates and, you know, maybe, you know, talk about what you guys see going forward and how that may affect the banks in our portfolio.
Sure. Well, let me say something very simple. 0% interest rate policy is bad for banks. We're not there. So first of all, that's really important. Secondly, the cost of deposits was driven higher, not just by interest rates, by the, what should I say, market freak out over Silicon Valley and First Republic. And by the way, what's important is the FDIC protected everyone, right? Nobody lost money. So I think that's really important as far as faith in the group. I can tell you the cost of funding for most banks is starting, you know, to come down because everybody believes we've hit the peak in interest rates. So without rates getting cut, you're already seeing deposit costs starting to come down in the banking space, the desperation. Obviously, if there's not a lot of loan growth, the need for deposits not as important. At the same time, you know, yes, you have some deposits repricing, but you have a lot of loans repricing. So there are banks we call asset sensitive where loans are repricing and repricing higher, which means more earnings. So if the funding pressure is off, there'll be some banks that actually benefit just from where we are today without any rate cuts. You know, one of our positions predicts 6 rate cuts this year. And that has an adverse impact on it. So every month that goes by without a rate cut, they make more money than the analysts think. So I think there will be some pleasant surprises from the group on that. There shouldn't be too much on the negative perspective, given the Fed hasn't cut rates yet. Funding costs are important to banking. I mean, that's the raw product out there. But at the end of the day, you don't need a lot of cuts. Where cuts will help eventually will be, as we mentioned before, commercial real estate. If they can fund at lower interest rates, that will be helpful to them. It'll allow for better cap rates, allow for better cash flows. So I think lower rates will be helpful. Market consensus right now is 3 cuts this year. I think the Fed kind of, you know, reiterated its stance. And by the way, the Fed has never been right as much as they were late in raising rates. They raised rates, you know, 75 basis points at a time, multiple meetings in a row, when there's a huge lag effect. I will also say this is a very political Fed. So if they see the economy slowing, they will cut, and they will cut aggressively. So I believe they can cut more than 75 basis points this year. And generally, I think that will be helpful to the economy, certainly helpful to commercial real estate. But we don't need cuts for the banking industry to do fine. 0% interest rate is bad for banking. That's very, very clear. So we're not going back there, hopefully anytime soon. Dan?
Thanks, Anton. I guess if we employed the 3 rate cut and holding, let's call it a balance sheet fairly static, the front end of the curve will come down, which means cost of funds comes down. not day one, but certainly over the 3 cuts, it will come down. Loans will continue to, for the most part, increase in terms of yield because they're priced on a slower pace than deposits are. So the net interest margin or net interest income, which is 80% of revenue, should start to accelerate as we go forward, which with the fairly high incremental margin associated with this industry should drive earnings power above what the street has for 2025. So we have increasing odds of earning surprises coming to the bank group.
Thanks, Dan.
Maybe what, about 10 minutes, 15 minutes left here, guys. You guys have always emphasized number one, management, number two, geographic location. Maybe talk about some of the areas of the country where you're kind of focusing in some of the investments in our portfolio.
Sure, I'm happy to. I follow the money, follow the people, and I think that if you can look at the states that have 0% as income taxes, they're drawing a lot of people, and so Florida has been a big beneficiary from New York State. Texas has been a big beneficiary from California. Tennessee is getting people from the Midwest, from Chicago. So those places literally have people moving there. They have businesses moving there. Obviously, we've seen that in Texas, where we've seen some very large tech companies move to Texas out of Silicon Valley. So that's just a natural advantage, right? If you just find the bank that is the average bank in those markets, it's going to have an advantage over the average bank in markets that are seeing outflow of people and businesses. So, those are 3 states that are important to us. The Southeast is booming as well. I think people like the weather. So I think on a cold day in the Northeast, it's probably a good thing to emphasize that. I left New York State in 2015. I can see palm trees in my background, but at the end of the day, that matters. It's just easy. I mean, if you're a bank in Florida, there's always absorption. People go, oh, Florida, boom and bust. Well, boom and bust is when speculation happens. And, I will say that there really hasn't been very much speculation. I mean, the housing industry is struggling to house people, to build enough homes, enough apartments to house people in places like Florida. Most of Texas, Austin has been overbuilt. But, there's been certainly not a lot of speculation in some of those growth markets. And obviously, if you can find banks that are taking advantage of that activity, you're going to create some return. And by the way, banks that are not in those markets would like a presence in those markets. Dan?
I'm going to take the opposite side of that coin. Just because we're not growing here in, let's say, Boston or Philadelphia, where I'm originally from. In order to gain market share in a zero-sum business, you have to acquire, which means you have to find the best run, best deposit franchise of the smaller banks in that city. Now, the top 3 guys don't care about it, but numbers 4 through 7 might care about 7, 8, 9, 10 in order to get market share to spread their cost, the technology cost that Anton referred to earlier, across a larger deposit franchise, across more employees, to improve their efficiency and to make them more profitable.
So to Dan's point, there are markets when we go, well, wait a second, why do you guys own some stuff in California? Because there's a lot of disruption going on there from an M&A perspective. We've seen some much bigger banks buy other big banks. We obviously saw some weakened banks. And because of that, that opportunity exists to hire better people, both in the back office and front office for these small banks, to get customers that are being neglected by those larger institutions. And that's why community banks, really can always do well, because people like to deal with people, right? Technology is important. It's an add-on, but at the end of the day, a business owner likes to talk to a person, and they like to talk to a decision maker. So when you're talking about just trying to find a decision maker, how many business owners get to talk to Jamie Dimon? Well, that's very few. So community banks have a role. I think the media has done an awful job about describing market share loss for community banks, because what they'll say is, look at the big guys are grabbing more market share. Sure they are, because they got First Republic, because they got pieces of Silicon Valley, because they got pieces of Signature. If you go below that, the small guys are holding their own, and it's pretty impressive. They like to talk about deposits coming down. Well, of course, deposits are coming down. Trillions of dollars of free money were created during the COVID situation. And it was stimulus to consumers, stimulus to businesses. That led to excess deposits. And that money wasn't going to stay there forever. Again, that's a mistake Silicon Valley made, thinking that money would stay there forever. But about $3 trillion in excess deposits were created. Maybe there's anywhere from 600 billion to $1 trillion left to flow out that was created from the COVID stimulus. But at the end of the day, that's normal. If you look at a long-term trend of deposits, deposits grow over time. It's just this was a special time where there were excess deposits created. But deposits are what make banks valuable. If you think about consumer finance companies that are not banks, they struggle in times like this because if credit gets worse, how do they raise money? How do they pay for the types of loans they're originating that maybe have lesser quality? So the other thing is that most community banks really don't have much of a consumer business. The big banks have captured that a long, long time ago. And so the margins on those loans, along the law, as well as the losses, they're not very attractive. So, you know, the traditional community bank that Dan and I invest in is going to mostly do small business lending, and that small business lending may very well be an operating account that's backed by their commercial real estate. So it's not just straight CRE without a business behind it. It's the CRE is the security behind the cash flows generated by that business.
That's great. You know, we have a portfolio here. I think we started, Anton, in late 2009. You know, you just kind of described your buy discipline. You know, for the audience, you know, we actually owned Signature Bank late last year, or actually I believe it was late 2022, and made money in it, and New York Community Bank and made money. You know, maybe talk a little bit about your sell discipline and what you saw in those instances to make you you know, get out of the stock.
Sure. And I would say Silvergate was on that list as well, because they were innovative. But you know what Signature and Silvergate had going against them was deposits, and expensive deposits, and deposits from the wrong kind of people. And when you see those trends going the wrong way from a deposit perspective, or the cost going up, you go, well, wait a second, the fundamentals here are changing, and I don't like the structure. In New York Community's case, is literally going through their earnings last quarter, prior to them getting into trouble with the regulators and going, okay, story's changing here. You know, the numbers aren't exactly what we'd like to see them. Dan and I don't care about whether a company makes earnings by a penny or misses by a penny. That's not what's important. It's the inputs. And if the inputs start to change, whether they meet or miss is irrelevant. It's the inputs changing. And then we've got to get out of the way. Did we expect those companies to fail or get into the same kind of trouble? No, we just thought they were not going to make us money. And I think that's really important. And the same thing goes for if you own a company and go, okay, I own this for a takeover, and it starts getting very close to its takeout value. And in today's environment, none of that exists. But in a healthier M&A environment, which we expect to come, companies will perform, and someone will start getting closer to takeout value. You know, we'll talk about that and go, hey, if there's 10% left, why would we be here? You know, because what if a deal doesn't happen? And obviously, if a deal does happen, could the merger arbs take that 10% away anyway? So why are we here? So, you know, the nice thing is we have hundreds of opportunities in front of us. And so we can always look for another opportunity. We were perfectly happy to get out of the way. We tend not to employ much cash in the fund because there almost always are opportunities. Now, the other thing that we're waiting for is the capital markets to open up again. What I mean by that is banks raising money for growth, raising money for mergers and acquisitions, initial public offerings. We haven't seen a bank IPO in quite some time, but we will see those kind of transactions happen, and we will take advantage of them. I tell you that Dan and I are starting to see that happen. Now, the transactions we're hearing about out there, maybe not of the best quality, so we're probably not going to invest in those. But the capital markets are starting to open up, and we're starting to sign non-disclosure agreements, getting a chance to look at these companies and decide whether we want to participate or not. And I think that's really important. I think IPOs will eventually happen. And I think index changes are also very, very important. You know, some of the names we own are not in the Russell 2000 and could get added. That creates a lot of buy opportunity. One of our positions, Provident Financial Savings, if they close their deal with Lakeland, we're waiting for regulatory approval. Not any fun, but it creates 25 days of buy interest from the Russell 2000 or one of the S&P sub-indexes, I think the 400 or 600. And that obviously has nothing to do with fundamentals, but certainly aids performance. So we're always happy for situations like that. Now, if a company gets deleted from the Russell and has pressure on it and its fundamentals are strong, well, again, there's an opportunity there for us to play. Or a company does a merger and acquisition deal, maybe as a buyer, and doesn't react well because the arbitrageurs are putting pressure on it. Again, a chance for us to take advantage of the market mispricing things. So we'll look for all of that, but we do think the capital markets will open up again for this space. And I think that'll really create some opportunity to create return.
Just turning to the regulation side of this, seems like that could be what you describe as a catalyst for increased mergers. But also, as you just said, it's quite a process to get these deals done. So how do you think that balances out?
The smaller deals are getting done pretty quickly. So, names like an equity bank is getting deals approved within 2 months. So that's a very different. So the smaller are not in the spotlight. A bigger company that I just mentioned, Provident, has taken well over a year, and there's no good reason for it. But the regulators just don't want companies to get bigger in that mid cap range for some reason. We actually just saw an approval for just $1 billion transaction that was bought by another bank in Texas. Prosperity just finally got approval yesterday. It was 18 months. So far too long, but Prosperity is a good sized institution, and the regulators just aren't kind to the bigger ones. The smaller institutions seem to get these transactions done more quickly, and that's what we tend to own. Tend to focus more on those small institutions where an equity bank can buy something and create 20% earnings accretion through a smart transaction without much regulatory risk. But again, you remove the regulatory risk in an election, Katie bar the door, because there'll be a lot of M&A happening in that scenario.
All right, I got 3 questions in the bank here. Maybe just address them quickly, and then we can kind of wrap this up. What would you describe as a poor quality deposit?
Sure. A poor quality deposit are certificates of deposit, right? Because they're short-term in nature. Generally speaking, they're sold to people who are yield hungry, right? They're not a relationship. They're going, I want the best price. Well, if you've got to pay the highest interest rate out there and have no relationship with that customer, that's a poor deposit. It's not core. A business checking account is a great core deposit. They don't have to pay interest rates on it. They've probably got a lending relationship with that company. They may be selling them treasury products. There's a lot to a whole relationship that goes on there, but a CD is the weakest type of deposit out there.
Next question was on the mid-cap space. Do you have any banks that you like there?
Well, buy the fund. But at the end of the day, we like lots of banks there. I mean, I'll give you one I just talked about. Earnings wise, Cadence Bank. They are the ones who predicted 6 interest rate cuts in their earnings. So the less cuts, actually, the more money that they make. So that there's one from an earnings catalyst to watch as we go into next quarter.
And the final question was, how many banks, I can answer this, how many banks are in the portfolio and how often do we kind of turn it over? Historically, we've run about 25 to 30 positions, and it's I'm trying to get the number here, but it's a fairly low turnover. I mean, if you want to hit on that.
Yep. Well, I mean, it's important for us to generally look for a long-term return. And when I mean long-term return, when you pick that management and that geography and that valuation, you're waiting for them to realize full value. So in an environment like this, nothing's at full value. Everything pretty much trades at a discount. And so you're waiting for that execution. If you don't like the way the execution is going, then you will turn over. And obviously my favorite kind of turnover is when a company gets taken out for a large premium and we don't like the buyer. So if we didn't own the buyer stock before that merger, why do we own it now? Now, there are cases where we're going to want to stay because it changes the nature of that buyer, or it may actually change the timing of the buyer. The buyer may actually become way more valuable because of what they bought in our portfolio, and we'll stick around to wait for that increase to happen. And, you know, years ago, we had just sort of an incredible run in North Carolina where we had one company buy lots of companies in the portfolio. That was Yadkin Financial. And they bought Vantage South and they bought several others. And at the end of the day, I think literally 4 institutions formed into Yadkin, which was essentially taken over by another bank out of Pennsylvania. And that created a company where we said, okay, that bank out of Pennsylvania going into North Carolina, it's going to have operational difficulties. It's going to have cultural difficulties. Thank you very much. That transaction is over now.
Yeah, I think I just ran the stat. It's a 15% turnover. So, that's it for the questions of the Q&A bank. If you guys want to just leave us with any concluding remarks.
I think, Dan, I'm going to let you conclude since I answered all the questions.
You're very kind, Anton. I guess the concluding remark would be that if you are a value investor who likes quality and has a longer versus shorter term time horizon, again, that's up, beauty is the eye of the beholder. Owning financial institutions, particularly smaller ones, may be like watching paint dry, but when it's done, it's really a Michelangelo on the wall. You're really happy you own it.
I'm going to quote the great Warren Buffett. Be greedy when others are fearful, and fearful when others are greedy. And that applies right now. People are fearful of the space, which is why these valuations exist. And they're absolutely greedy on the high flying stocks in the NASDAQ right now. And, Dan and I've seen this picture before. 2000 was an example of where the small cap financials roared, and the dot-coms got killed. And not to say any of those companies aren't good companies, but valuations are very full there. So right now we want to be greedy on the fearful, where people are fearful.
Great.
Well, guys, thank you so much. This was a great discussion. If anyone has any follow-up, you can please contact us. But thank you again, everyone. Have a nice day.
Thank you, Paul.
Thanks, everyone.
Thanks, everyone.
Take care.